Okay, so today we're going to do a deep dive into Helios Capital's January 2024 investor guide.
Sounds good.
And they're making some pretty bold claims here about the Indian stock market.
Yeah.
They say that over the past 25 years, investing in the Indian stock market actually outperformed even
Wow.
Warren Buffett's Berkshire Hathaway. And we're talking USD returns here. So that's a pretty big statement, right?
That's huge. Yeah. What's interesting is they don't just seem to be looking at past performance, though, right?
Right.
They argue that India is poised for like a period of sustained growth that's actually driven by several powerful megatrends.
So it's not just like riding a hot streak.
No.
That's a fundamental argument here.
Exactly. They're talking about like a perfect storm of economic factors that are all converging to create this really, really unique opportunity.
Okay, so give me an example.
Well, one of the examples that really stood out to me was just the fact that India is projected to become the world's third largest economy by the 2030s. I mean, just to put that into perspective,
Yeah.
they're adding an economy roughly the size of Argentina to their GDP every single year.
That's a staggering pace of growth.
Yeah.
But what about the risks? I mean, India has faced political uncertainty.
Right.
We've seen market volatility there, even wars during those 25 years.
Okay.
I mean, does Helios address that at all?
They do, and they acknowledge that volatility is a thing. But they point out that Buffett defines risk as permanent loss of capital.
Right.
Which the Indian market hasn't experienced over this period.
Okay.
In fact, they highlight that actively managed Indian funds have beaten even those impressive index returns that we were just talking about.
So essentially what they're saying is that for long-term investors, those dips might actually be buying opportunities.
That's their argument, yeah.
But, I mean, is it really as simple as just buy India and wait?
It's never quite that simple, is it?
Right.
Helios has a very specific investment philosophy, and a big part of that is understanding what they call India's megatrends. And I think this is really key to what they're talking about.
Okay.
Because these aren't just fleeting trends. They're forces that will shape the country's economic landscape for years to come.
All right, well, let's unpack these megatrends then.
Okay.
What are we talking about here?
One of the most significant ones is India's demographics.
Okay.
I mean, they have a young and rapidly growing population with a burgeoning middle class.
Right.
This translates into a massive consumer base with increasing spending power.
So you're talking about a classic case of rising incomes leading to greater demand.
Absolutely. And think about the impact of that on industries like consumer goods, retail, even healthcare.
Makes sense. A young growing population is a classic indicator of economic potential.
Yeah.
What other megatrends are they highlighting?
Another big one is digitization.
Okay.
India is a global leader in mobile data consumption.
Really?
This is driving a surge in e-commerce, digital payments, and just a whole new wave of tech-driven businesses.
So they're not just consumers, they're tech-savvy consumers.
Yeah.
And that's a powerful combination.
It is.
But doesn't that also mean increased competition?
Oh, of course.
I mean, both domestically and from global giants.
Yeah, I mean, that's a given. But Helios believes that Indian companies are actually well-positioned to compete. I mean, they're agile, they're innovative, and they understand the local market.
Makes sense.
And plus, India's government has been actively promoting digitization, so that's creating a really favorable environment for growth.
It sounds like they're betting on India's ability to essentially leapfrog ahead in the digital economy.
Yeah.
But what about the more traditional sectors? Are those being left behind?
Not at all. In fact, Helios points to India's massive infrastructure build-out as another key megatrend.
Okay.
They're investing heavily in things like roads, railways, ports, and energy, which makes it an attractive destination for manufacturing and industry.
So they're trying to position themselves as a sort of global manufacturing hub and capitalize on those kind of geopolitical shifts we're seeing.
They are. It's a bold move, for sure.
It is.
And it's not without its challenges.
Right.
But Helios seems to believe that India's long-term potential outweighs the risks.
Okay.
They also point to the rise of domestic investors, particularly through something called systematic investment plans, or SIPs, as a stabilizing force in the market.
Hold on. SIPs. Could you elaborate on that a little bit for our listeners who might not be familiar?
Sure. So SIPs are essentially a way for individuals to invest regularly in mutual funds.
Okay.
Even with small amounts of money.
Got it.
This steady flow of domestic capital provides a buffer against the volatility that you often see in emerging markets.
So it's like building a solid base of support from within to make the market less susceptible to external shocks.
Right.
That's interesting. But how does all of this translate into actual stock selection?
Right.
I mean, India has a huge stock market.
It does.
Where do you even begin?
Well, that's where Helios's elimination investing philosophy comes into play.
Okay.
It's kind of a unique approach, and they're not trying to find the next hot stock.
So what are they doing?
They're focused on avoiding mistakes. They believe it's actually easier to spot bad companies than to predict long-term winners.
That's interesting. So how do they actually go about identifying those bad companies?
Well, they use a framework called EITM, which stands for the 8 factors they use to ruthlessly eliminate companies with red flags.
Okay, so it's like a multi-layered screening process.
Yeah.
Designed to weed out the companies that are likely to underperform or pose significant risks.
Exactly. And this is where their deep understanding of the Indian market really comes into play.
Okay.
Because they're not just relying on generic metrics. They're looking at factors that are very specific to the Indian context.
This is already starting to sound like a much more sophisticated approach than just chasing those, India growth story headlines.
Yeah, I think they're trying to dig a little deeper. But what happens to the companies that actually make it through this elimination process?
Right.
How do they actually build a portfolio from there? Well, that's where things get really interesting because they use what they call a barbell approach.
Okay.
They're balancing good stocks with emerging good stocks.
So it's like a way to combine stability with high growth potential.
Yeah, think of it as, you've got the anchors of the portfolio, those steady performers that form the foundation.
So the good stocks,
Right.
Those are the ones that are going to provide that stability.
Exactly. These are companies with proven track records, strong fundamentals,
Right.
and predictable earnings growth.
Right.
They might not offer the most exciting returns,
Right.
but they provide that reliable base.
Got it. And then on the other side of the barbell, you've got the emerging good stocks.
Right.
Those are the ones with the higher growth potential,
Yeah,
but also higher risk.
exactly.
Yeah.
These are companies that are earlier in their growth cycle.
Yeah.
They might be disruptors, innovators, or simply companies that are undervalued by the market.
So they're balancing those two.
They are. They think that by balancing those two types of stocks, they can achieve both growth and stability.
This barbell approach is starting to make a lot of sense, especially in a market like India,
Yeah,
which is known for both its dynamism and its volatility.
absolutely. But how do they decide which specific companies to include in each category?
Right. What are the criteria?
Well, that's where their deep research and analysis come into play. They have a team of analysts who are constantly evaluating companies,
Okay.
looking at their financials, their management teams, their competitive landscapes, and how they align with those key megatrends we were talking about.
So it's a combination of top-down looking at the macro trends
Yeah,
and bottom-up evaluating individual companies.
exactly.
Sounds like a pretty rigorous process.
It is, and they're very transparent about their methodology, too.
Oh, really?
They publish detailed research reports outlining their investment thesis for each company they hold.
So they're not afraid to share their thinking.
Nope, not at all.
That's refreshing to hear because too often investment firms are shrouded in secrecy.
Yeah.
Makes it difficult to understand their decision-making process.
Right.
But Helios seems to be taking a different approach.
They believe that transparency is essential for building trust with their investors.
That makes sense.
And I think that's one of the reasons they've been so successful.
It's a compelling case they're making for their approach.
Yeah.
But there's one more piece of the puzzle we need to discuss before we dive into their specific stock picks.
Okay.
And that's what they call the MSCI flaw.
All right.
So what's that all about?
Well, it's their term for a structural issue with how India is represented in the MSCI Emerging Markets Index,
Okay.
which is a major benchmark for global investors. They argue that India's weighting in the index is disproportionately low compared to its economic size and market capitalization.
So they're saying India is essentially undervalued on the global stage?
Exactly. And they believe that this is due to a technicality in how the index is calculated. They call it the free float factor, which penalizes companies with high insider ownership.
Okay.
Something that's very common in India,
Right.
especially among those well-run, growing companies.
So you're saying a quirk in the index methodology is potentially obscuring India's true value.
Yeah, that's their argument.
Interesting.
And they believe that as this flaw becomes more widely recognized, it will lead to increased foreign investment in India,
Okay.
driving up valuations and creating significant opportunities for those investors who are positioned early.
Oh, that's a bold claim.
It is, but it also makes you wonder if this so-called flaw is really a flaw or simply a reflection of the unique characteristics of the Indian market.
That's a great question, and it's one we'll need to explore further as we delve deeper into Helios's analysis and their specific investment recommendations.
Absolutely.
This is already shaping up to be a fascinating deep dive.
Yeah, it is.
We've got India's powerful megatrends, Helios's unique investment philosophy, their barbell approach to portfolio construction, and now this intriguing MSCI flaw to consider.
Yeah.
It's clear they've done their homework, and I'm eager to see how all of these pieces fit together.
I agree. Helios has painted a compelling picture of the opportunities in India.
Mm-hmm.
But they've also highlighted the importance of being selective and understanding the nuances of this complex and dynamic market.
Right.
So let's dig into some of the specifics and see how they're putting their ideas into action.
Sounds good to me.
All right.
Okay, so let's get into the nitty-gritty of Helios's stock-picking strategy. You mentioned they use these 8 elimination factors to weed out potentially problematic companies.
Right.
So let's dig into those a bit more. What are some of the things that would send a company straight to their nope list?
Well, one of the first things they look at is what they call the bad theme. Basically, it's about assessing whether a company is operating in a market with enough potential for growth.
So even if a company seems well managed, if it's in like a shrinking or stagnant industry, it's a no-go.
Exactly. They're looking for companies that are riding those powerful megatrends we were talking about.
Right.
Not fighting against the tide.
Makes sense.
Like a great example they use in the guide is the DVD manufacturing business.
Okay.
No matter how efficient a DVD manufacturer is, their market is simply disappearing.
Right. There's no point in investing in a company if its industry is on the decline,
Yeah,
even if it's the best player in that shrinking space.
exactly. Another critical factor is what they call unfavorable industry dynamics.
Okay.
This is where they really dig deep into the competitive landscape, regulatory environment, and technological trends within an industry.
So it's not just about being a good company.
Right.
It's about being a good company in a good industry.
Exactly. They give an interesting example in the guide of a pharmaceutical company
Right.
that's facing patent expirations on its key drugs.
Ooh, that's a tough one.
Yeah, even if the company has a great track record, those patent cliffs represent a significant challenge.
Right.
That could impact its future earnings and growth prospects.
So they're looking for companies that have a clear path for sustained growth, not those facing major headwinds or disruptions in their core markets.
Exactly. And speaking of disruption, that's another key factor they consider,
Okay.
potential for disruption.
This one seems particularly relevant in today's world,
It is.
where technology and innovation are constantly changing the game.
Yeah, they're looking for companies that are adaptable and innovative.
Right.
And able to embrace new technologies and changing consumer preferences.
So those companies that are clinging to outdated business models or resistant to change,
Yeah,
they're probably going to get flagged here.
most likely. They use the example of a traditional retail chain that's been slow to adapt to the rise of e-commerce.
Makes sense.
Even if the company has a strong brand and loyal customer base, its reluctance to embrace online channels could put it at a significant disadvantage.
Yeah, that's a great example.
Yeah,
It highlights the importance of being forward-thinking and willing to adapt in a rapidly evolving marketplace.
absolutely. Now, shifting gears a bit, another crucial factor for Helios is Chink's weakness in management background strategy.
This makes perfect sense. Even the best business idea can falter if the people at the helm aren't up to the task.
Oh, for sure.
So how do they actually assess the management team?
They conduct really extensive background checks.
Okay.
They scrutinize track records and really try to evaluate the strategic vision of the leadership team. They're looking for experience, integrity, and a clear plan for the future.
So a company with a history of accounting scandals or a CEO with a questionable track record,
Yeah,
that would likely raise some red flags here.
absolutely. They want to see a management team that's aligned with the interests of shareholders and capable of executing the company's strategy effectively.
It's not just about the numbers.
Yeah, right.
It's about the people and leadership.
Exactly. And speaking of ethical considerations, poor corporate governance is another major red flag for Helios.
This is so important, especially in emerging markets,
Yeah.
where transparency and accountability aren't always a given.
Right.
So what are some of the things they look for in this area?
Well, they really scrutinize the board structure. They're looking for independent directors, a diversity of perspectives. They also look for transparency in financial reporting, a commitment to ethical practices, and a strong track record of compliance.
So a company with a board that's dominated by insiders or one with a history of regulatory violations,
Yeah.
they would probably get flagged here.
Most likely, Helios believes that good corporate governance is essential for protecting shareholder interests and ensuring long-term sustainability.
It's like building a house with a solid foundation.
Right.
Without good governance, the whole structure is at risk.
Exactly. And finally, we come to what they call low-quality accounting.
Okay.
Now, this one can be a bit trickier to spot.
Right, because sometimes those accounting irregularities can be buried pretty deep in the financial statements.
They can.
Yeah.
So how do they go about uncovering those potential issues? Well, they have a team of very experienced analysts who meticulously scrutinize financial statements,
Okay.
looking for any signs of manipulation, aggressive accounting practices, or inconsistencies in reporting.
So they're not just taking the numbers at face value?
Nope, they're looking for red flags like off-balance sheet transactions, unusual revenue recognition practices, or discrepancies between reported earnings and cash flow.
It sounds like they're leaving no stone unturned in their quest to uncover any potential accounting shenanigans.
Exactly. And this is where their deep understanding of accounting principles and their experience in analyzing Indian companies really comes into play.
Okay, so we've covered the 6 kind of permanent rejection factors.
Right.
These are the deal breakers, the things that would automatically disqualify a company from consideration.
Mm-hmm.
But they also have 2 temporary rejection factors,
Right.
which are more about timing and valuation.
Exactly.
So these are the situations where a company might be fundamentally sound, but just not the right investment at this moment.
Exactly. The first one is negative medium-term triggers. This is where they look for any potential challenges or headwinds that might impact a company's performance in the near future,
Okay.
even if its long-term prospects seem promising.
So it's about anticipating those potential storm clouds,
Yeah.
even if the sun is shining brightly today.
Right. What are some examples of those negative triggers?
Right.
Well, it could be anything from an anticipated slowdown in a key market
Okay.
to upcoming regulatory changes or even increased competition from new entrants.
So even if a company is doing well right now, if Helios sees some potential trouble brewing on the horizon, they'll hold off on investing.
Exactly. They're not afraid to be patient and wait for a better entry point.
That's a disciplined approach.
Yeah.
It's tempting to chase those hot stocks, but sometimes the best investment is the one you don't make.
Absolutely. And the other temporary rejection factor is what they call unreasonably high valuations.
Right, the classic buy low, sell high
Yeah.
principle. But how do they actually determine what constitutes an unreasonably high valuation?
Well, they use a variety of valuation metrics like price-to-earnings ratios, price-to-sales ratios, and discounted cash flow models to assess whether a company's stock price is justified by its underlying fundamentals.
So they're looking for companies that are trading at a discount to their intrinsic value, not those that are hyped up by the market.
Exactly. They believe that buying companies at the right price is crucial for generating those long-term returns.
Right.
They're not afraid to walk away from a deal if they think the price is too high,
Makes sense.
even if it's a company that they otherwise like.
That's a very smart approach. It's easy to get caught up in the excitement of a growth story,
It is.
but it's important to remember that valuation always matters.
Always. So these 8 factors taken together form the foundation of Helios's elimination investing philosophy.
Okay.
It's a very rigorous process that helps them avoid those costly mistakes and focus on those companies that are most likely to deliver sustainable returns.
This system seems incredibly thorough,
It is.
but I'm curious, how does it actually work in practice? I mean, do they literally go through every single company in the Indian market and apply these 8 factors?
That would be a monumental task.
It would.
So they actually start with a universe of companies that meet certain basic criteria like market capitalization and liquidity.
Okay.
And then they apply those 6 permanent rejection factors to narrow down the list.
So it's like a multi-stage filtering process,
Mm-hmm.
weeding out the companies that don't meet their standards at each step.
Exactly. The companies that survive that first round of screening then move on to the next stage where they apply those 2 temporary rejection factors.
So they're looking for companies that are not only fundamentally sound, but also well-positioned for near-term success and trading at attractive valuation.
Precisely. And the companies that made it through both rounds of screening end up on what they call their core buy list.
So this core buy list is a highly curated selection of companies that have passed all of their rigorous tests.
Right, but how do they actually go from a list of companies to an actual portfolio?
Yeah, that's a good question.
That's where their expertise in portfolio construction comes in.
Okay.
They take that core buy list and start building a portfolio that aligns with their philosophy, their risk tolerance, and their outlook for the market.
So they're not just randomly picking companies from the list.
No.
They're strategically allocating capital based on their overall strategy.
Exactly. And remember that barbell approach we were talking about?
Right.
That plays a key role in their portfolio construction process.
Right, the balance between the good stocks and the emerging good stocks.
Exactly. So the good stocks are that foundation.
Mm.
The companies they believe will provide stability and consistent returns.
Okay.
These are typically well-established companies with proven track records, strong competitive moats,
Right.
and predictable earnings growth. They might not offer the most exciting returns,
Right.
but they provide that solid base for the portfolio.
And then on the other side, you've got those emerging good stocks.
So,
Those are the ones with the higher growth potential, but also higher risk.
precisely. These are the companies that are earlier in their growth cycle.
Okay.
They might be disruptors, innovators, or simply companies that are undervalued by the market.
So they're balancing those two?
They believe that by balancing those two types of stocks, they can achieve both growth and stability.
It's a good approach.
It is.
This barbell approach is starting to make a lot of sense, especially in a market like India,
Yeah,
which is known for both its dynamism and its volatility.
absolutely. But how do they decide which specific companies to include in each category?
Right.
Well, that's where their deep research and analysis come into play.
Mm-hmm.
They have a team of analysts who are constantly evaluating companies, looking at their financials, their management teams, their competitive landscapes, and how they align with those key megatrends we were talking about earlier.
So it's a combination of top-down,
Yeah.
looking at those macro trends,
Mm-hmm.
and bottom-up evaluating those individual companies. It sounds like a pretty rigorous process.
It is, and they're very transparent about their methodology, too.
Oh, really?
They publish detailed research reports outlining their investment thesis for each company they hold.
So they're not afraid to share their thinking.
Nope, not at all.
That's refreshing to hear because too often investment firms are shrouded in secrecy,
Yeah.
making it difficult to understand their decision-making process.
Right.
Helios seems to be taking a different approach.
They believe that transparency is essential for building trust with their investors.
Right, and I think that's one of the reasons they've been so successful.
It is. It's a very compelling case they're making for their approach.
It is, but let's get specific.
Okay.
What are some of the actual companies that they're highlighting in this guide?
Okay. Well, they dive into several sectors they believe are particularly well positioned to benefit from India's growth story.
Okay.
And they highlight specific companies within those sectors that they believe are worth considering.
Okay, I'm ready to hear about some of these picks. What sectors are they most excited about? All right, so let's get into some specifics. Which sectors are catching Helios's eye, and what kind of companies are they picking within those?
Well, one sector they're particularly bullish on is financials.
Okay.
They see a huge opportunity in India's underpenetrated financial services market.
Makes sense.
You know, a rapidly growing middle class means there's going to be a surge in demand for everything from bank accounts and loans to insurance and investment products.
Well, as more people enter the middle class, they need access to those financial tools
Yeah.
to manage their money, grow their wealth, protect their assets. It's a classic emerging market growth story.
Yes, absolutely.
But what specific companies are they looking at within this sector?
Well, they highlight several private sector banks that they believe are well positioned to capitalize on this growth.
Okay.
I specifically mention HDFC Bank and Kotak Mahindra Bank as examples.
HDFC Bank, I've heard of that one.
Yeah,
They seem to be everywhere in India.
they are, and that's part of their appeal. They have a vast branch network, a strong brand reputation, and a growing digital presence.
Okay.
Helios believe they're well positioned to attract new customers and grow their market share.
But aren't traditional banks facing increasing competition from those fintech startups and digital-only banks?
Oh, absolutely. And that's why Helios also highlights some of the leading fintech companies in India,
Okay.
like Paytm and PhonePe.
Hmm.
They see these companies as potential disruptors that are challenging the traditional banking model and offering those innovative solutions for a tech-savvy population.
So they're not afraid to invest in both the established players and the up-and-comers.
Right.
As long as they align with their investment criteria. It's that barbell approach in action.
Exactly. They're looking for companies that can adapt to that changing landscape and capitalize on those growth opportunities, regardless of whether they're a traditional bank or a fintech startup.
Right. Makes sense.
Yeah.
Another sector they highlight is consumer discretionary, which makes sense given that massive consumer base we were talking about,
Absolutely.
right, with rising incomes and a growing middle class. People have more money to spend on things they want, not just the things they need.
Exactly.
So what kind of companies are they looking at within this sector?
Well, they're focusing on companies that cater to the aspirations of India's burgeoning middle class.
Okay.
They specifically mention companies like Titan,
Okay.
which is a leading watch and jewelry retailer,
Huh.
and Avenue Supermarts, which operates that popular D-Mart chain of supermarkets.
I've heard of D-Mart.
Mm-hmm.
They're known for their low prices and wide selection.
Yeah.
Is that what Helios is attracted to?
It's part of it. They like D-Mart's efficient business model, their strong supply chain management, and their focus on value for money.
Okay.
These are all factors that really resonate with those Indian consumers, especially in a price-sensitive market.
So it sounds like they're looking for companies that really understand that Indian consumer
Yeah.
and can deliver products and services that meet their specific needs and preferences.
Yeah. Exactly. And they're not just looking at those big consumer brands either.
Okay.
They also highlight some of the smaller niche players that are catering to specific segments of the market.
Interesting. So give me an example.
Sure. For example, they mention V-Guard Industries,
Okay.
the company that makes voltage stabilizers and other electrical appliances.
Voltage stabilizers.
Yeah.
Interesting.
Right.
Why that particular company?
Well, because they address a real need in India where power fluctuations are common.
Right.
V-Guard has built a really strong brand reputation for reliability and quality, and Helios believes they're well-positioned to benefit from that rising demand for electrical appliances as incomes rise.
So they're looking for those under-the-radar companies that are solving those real problems
Yeah.
and capitalizing on those specific market opportunities.
Yeah.
It's about finding those hidden gems that might not be on everyone's radar.
Exactly. They're not afraid to venture beyond those well-known names and look for those companies that are tapping into those niche growth areas.
This has been fascinating. It's clear that Helios is taking a very nuanced and thoughtful approach to investing in India. They're not just chasing headlines. They're digging deep, understanding the dynamics of specific sectors, and identifying those companies that are well-positioned to benefit from those long-term growth trends.
I agree. Their approach is a great example of how to combine those macro insights with that microanalysis to identify those compelling investment opportunities.
Right.
They're not just betting on India, they're betting on those specific companies that they believe are capable of executing and delivering value for their shareholders.
It's a compelling case they're making. But as always, it's important for investors to do their own research and make decisions that align with their own investment goals and risk tolerance.
Absolutely.
The Indian market is full of opportunities, but it's also a complex and ever-evolving landscape.
That's right. There's no one-size-fits-all approach to investing in India.
Right.
But Helios has provided a really valuable framework and a wealth of insights that can help guide investors as they navigate this exciting market.
This deep dive has been incredibly insightful. I'm feeling much more informed about the opportunities and challenges in the Indian market.
Good.
And I'm particularly impressed by Helios's rigorous and transparent approach to investing.
I agree. It's been a fascinating exploration, and I hope it's inspired our listeners to dive deeper and explore the potential of this dynamic market.
And who knows, maybe you'll find your own emerging good stock hidden amongst those megatrends.
Yeah.
Thanks for joining me on this deep dive. Until next time, keep exploring, keep learning, and happy investing.